Good afternoon. Moving right along in our real estate finance in chapter 5, page 102, 103, it talks about the finance instruments. And basically, it's a fancy word for document. The first instrument that it talks about is the promissory note. And just a very simple form of that is on page 103 at the top in the box. And basically the note just lines out how the borrower intends to pay the money back that they borrowed. It lines out the note amount or the loan amount, the interest rate, and the term. What the consequences would be in the event of a buyer default. Well, a form similar to this is used in real estate finance, only it's a lot more inclusive. Page 103, 104, it talks about installment agreements or installment notes in this chapter. With recourse and without recourse. Y'all can kind of read through the book. It's real easy to get through, real self-explanatory. On page 105, it talks a little bit about the historical background of collateral and the purpose of security instruments. Basically, a security instrument gives the holder of that instrument, or the bank, in our scenario, the ability to foreclose or repossess the property. 106, 107 talks about mortgages. A mortgage and a deed of trust are, even though they're different words, they mean the same thing. It talks a little bit later in the chapter about the differences between a judicial foreclosure and a non-judicial foreclosure. Y'all can read the differences about that. One thing about this book, it is a national book, so it doesn't line out the exact laws in terms of Texas, but Texas is what's called a non-judicial foreclosure state. So what that means is that when the buyer, your buyer signs the note and the deed of trust, they're basically giving up their right for their foreclosure proceedings to be heard in front of a court or a jury. So these documents that the customer signs at closing makes it easier for the lender to do a foreclosure. Moving on into page 110, 111, it talks about the rights of redemption in regard to a foreclosure sale or a court-ordered sale, a sheriff's sale, and of course, you hear a lot about tax sales and things like that. The first Tuesday of every month, there is a sale at the courthouse, Taylor County Courthouse. If you ever wanted to go down and take a look at that, how that's conducted, it is in the southeast foyer of the courthouse, and that's where those foreclosure sales occur. On the top of page 112, it talks a little bit about a judicial foreclosure and about how the title is taken back. And then on page 113, it goes into a lot more detail on the non-judicial foreclosure. Y'all can kind of take a look at that. At the bottom of page 115, there's alternatives to foreclosure. In the bottom right-hand corner, it gives some of the alternatives, and chapter details those out. In the event or in the light of the foreclosure crisis of 2008, 2009, 2010, the federal government came in and added some safeguards to give homeowners a little bit more opportunity to help cure these defaults and to help cure or help get the back payments caught up in loan workouts, things like that, just to basically stop this catastrophic event of foreclosures that occurred throughout the whole United States. Finishing out page 5, it goes into a lot of the partial release clauses, alienation clauses, assumptions. On page 125, it talks about the types of real estate loans that are out there available to people, and y'all can read through that. Home equity loans. On page 126, it talks about purchase money mortgages. Basically, a purchase money mortgage is the mortgage, the type of mortgage that's used by a customer to buy a home. That's simply all that is. Let's kind of get into chapter 6. Don't forget to run through your chapter quizzes in chapter 5 on page 141, 142. Answer keys right there on page 143. Let's talk a little bit about chapter 6 and the kind of the features of a residential loan. On page 146, it talks about, and as you get further into your real estate career, it talks about amortization. And amortization is basically where somebody borrows a certain amount of money and it is paid back in installments of fixed amounts over time. We do this with car notes, we do it with house notes, we do it with anything typically that we finance for a long period of time. A credit card company, credit card payment is not an amortized loan. There's credit card companies have variable interest rates. They have minimum payments. Sometimes people pay more, sometimes they pay less. So a credit card payment or a credit card bill or the charges on a credit card are not considered to be an amortizable loan. So you can look at the bottom of page 147 and find out how an equal fully amortized loan would be structured on paper. And that's a real easy concept to understand. You have a $100,000 loan, 6% over 30 years. So your total payment's $599.55, out of which the interest is $500 and the principal is $99.55. Well, then payment number 2, you're paying a little bit less interest, a little more principal, but you can see the payments stay the same. The monthly payments stay the same. The monthly payment is just partitioned differently, with more going to principal each month than is going to interest. A partially amortized loan would be one that would be maybe that had a balloon at some point in time. Maybe you borrowed $100,000, amortized it over a 30-year time period, but the note was going to be due in 5 years. So that's a partially amortized loan. You can kind of read through some of the disadvantages and advantages over, a 30-year note versus a 15-year note. Any of y'all that have ever listened to Dave Ramsey, he talks about the benefits of a 15-year loan in terms of the total interest that a borrower would pay over the life of that loan, significantly less. Loan-to-value ratios, another relatively easy concept to understand. I can kind of read through that. Page 152. 158, 159 goes into a little bit about some more kind of hybrid type loans, different type loans that we don't use very often, adjustable rate mortgages, negative amortization mortgages. Y'all can kind of read through that. But anyway, in Chapter 6, again, don't forget to read through your terms in the back of the book and review your quiz. Your first test is coming up due, I think, Tuesday. So once we get past that and get those graded, then I'll post a test number 2, and then we'll get started with that. So thanks a lot. And again, email me if you have any questions. If you want me to call you back, add your phone number. I certainly don't mind helping you through this. I know this is your first online class. They're a little bit faster paced, especially in the summer. You have to be a little more disciplined to make sure you read. Reading is so important. Getting through the chapters, reading through the chapters, staying ahead are all good practices to be successful taking an online class. So hopefully these video lectures, I know they're kind of short. I've just got limited time that I can upload these on YouTube and get them into Canvas. I'm limited on the amount of space that it takes up. So anyway, again, call me, email me if you need me, and hope this helps. Thanks.